Hi YouTube, it's Average Joe, your channel where we talk about anything around personal finance and smart money moves for the everyday guy. Welcome back to our channel. Today we're diving deep into a topic that impacts every aspect of your financial life: inflation and interest. You'll discover how they can affect your financial goals, savings, and investments. Plus, we've got 5 killer tips and tricks to help you protect your hard-earned money as inflation rises. Stick around, this knowledge is gold. Let's start with the basics. What exactly are inflation and interest, and how do they shape your financial journey? Inflation, simply put, is the natural increase in the prices of goods and services over time. Think of it as the cost of living going up gradually. For example, what cost you $100 today might cost $105 or more in a year. Imagine if you had $100 saved up for a year, but prices rose by 5%. That same $100 could now buy you less than it could before. Inflation effectively erodes the purchasing power of your money. On the flip side, we have interest. Interest is like a reward you earn on your savings or investments. It's a percentage of your money that's added to your account regularly. One could say that your money works for you. It's like a superpower that can make your money grow over time. But here's the kicker. Inflation and interest are locked in a constant tug of war. If your money isn't growing faster than inflation, you're actually losing purchasing power. To make it more relatable, think of it as a race. If your savings or investments aren't running faster than the pace of inflation, you're falling behind in the financial race. So in a world where prices gradually rise and your money's value is at stake, how can you ensure your financial stability and growth? That's what we'll explore in this video. Now, how do these economic forces affect your financial goals? Imagine this scenario. You're diligently saving for a down payment on your dream house. You've been setting aside money month after month, and you're almost there. But here's the twist: inflation. Inflation acts like a silent thief, slowly eroding the purchasing power of your savings. While your money is sitting in your account, the cost of homes and everything else is gradually rising. As a result, that hard-earned down payment you've been working so tirelessly to save might no longer be enough to secure your dream home. You're essentially falling behind in your financial race towards homeownership. Now let's shift our focus to retirement planning. You've been diligently investing in your retirement accounts, envisioning a comfortable retirement. But there's a catch. Meet inflation again. If the returns on your investments don't outpace inflation, your nest egg may not provide the lifestyle you've been dreaming of during your golden years. So, what's the key takeaway here? Understanding the impact of inflation and interest is crucial because it can make the difference between achieving your financial goals and watching them slip away. But don't worry, we're not here to scare you. We're here to equip you with the knowledge and strategies to make inflation and interest work for you, not against you. Here's where things get interesting. We have a financial superhero called compound interest. Compound interest is like magic for your money. It's the concept of earning interest on your interest, and it can make your savings and investments grow at an accelerating rate. Here's how it works. Let's say you invest $100, and it earns interest equal to $7. In the next period, you will not only earn interest on your initial investment, but also on the interest you've already earned. This time, you earn interest on $107. This compounding effect creates a snowball effect where your money starts to grow exponentially over time. It's like planting a money tree that sprouts more money, and those new branches also bear fruit. The earlier you start harnessing the power of compound interest, the more significant its impact. Time is your best friend when it comes to compounding. It's all about letting your money work for you over an extended period. Now, the million-dollar question: how do you protect your financial goals, savings, and investments from the eroding power of inflation? Here are our top 5 tips and tricks. Tip number 1, diversify your investments. Don't put all your eggs in one basket. Diversify your investments across different asset classes like stocks, bonds, and real estate. Each of these asset classes responds differently to inflation. For example, stocks may provide a hedge against inflation as they have the potential to increase in value over time. By spreading your investments across various asset classes, you're reducing the risk associated with any single investment and increasing the likelihood of your portfolio keeping pace with or outpacing inflation. Tip number 2, invest in inflation-protected securities. Look into Treasury inflation-protected securities. Tips: these government bonds are designed to keep pace with inflation, preserving your purchasing power. With TIPS, the principal amount adjusts with inflation, ensuring that your investment maintains its purchasing power. When inflation rises, the value of your TIPS increases accordingly. Tip number 3, dividend stocks. Invest in dividend-paying stocks. Companies that consistently raise their dividends can provide a growing income stream that outpaces inflation. As these companies thrive, they often increase their dividend payouts, providing you with a growing income stream. This income can help offset the rising costs of living caused by inflation. Coca-Cola is a great example of that, as paid dividends for years and not been that affected by inflation. Tip number 4, increase your retirement contributions. Boost your contributions to retirement accounts like 401ks and IRAs. The more you invest now, the more you give compound interest a chance to work its magic. Over time, those extra contributions can grow significantly and help you keep up with or exceed inflation. Tip number 5, create an emergency fund. Have an emergency fund with at least 3 to 6 months worth of living expenses. With an emergency fund, you're less likely to dip into your investments or use credit during unexpected financial setbacks caused by inflation or other unforeseen circumstances. These 5 strategies are your toolkit to combat the eroding effects of inflation. By applying them wisely, you can make sure that your financial goals remain on track, even as the cost of living rises. Let us now better understand the underlying effects of interest rate and inflation in our society. Let's start by understanding some factors affecting the interest rate. Monetary policy. One of the most significant factors influencing interest rates is the monetary policy set by the central bank, such as the Federal Reserve in the United States. Economic conditions. In a robust economy with high demand for loans, interest rates tend to rise. In contrast, during economic downturns, central banks may lower rates to encourage borrowing and spending. Inflation expectations. If lenders expect inflation to rise, they may charge higher interest rates to compensate for the decreasing purchasing power of the money they will receive in the future. Government debt. When governments issue more debt, they may need to offer higher interest rates to attract investors, particularly in competitive markets. High government debt can lead to increased rates for all borrowers. Global economic conditions. Factors like currency exchange rates and international capital flows can influence the demand for domestic currency, affecting interest rates. As we now understand effects of interest rate, what factors can affect inflation? Demand pull inflation. This occurs when demand for goods and services exceeds their supply. Businesses raise prices to take advantage of the increased demand, leading to inflation. Cost push inflation. This type of inflation is driven by rising production costs. Factors like increasing labor costs, higher prices for raw materials, or supply chain disruptions. Monetary policy. Central banks can directly influence inflation through their monetary policy. By raising or lowering interest rates, central banks aim to control the money supply. Exchange rates. A weaker domestic currency can increase the cost of imports, leading to higher prices for foreign goods and contributing to inflation. Supply shocks. Unexpected events like natural disasters, wars, or geopolitical tensions can disrupt supply chains and lead to supply shortages. These shocks can cause short-term spikes in prices, leading to inflation. So there you have it, folks. Inflation and interest are 2 powerful forces that can either work for you or against you. With the right knowledge and strategies, you can make them your financial allies. If you found this video eye-opening and want to learn more about mastering your finances, don't forget to hit that like button, subscribe, and share this video with your friends and family. Together, we'll conquer financial challenges and build a brighter future. Until our next video, remember, inflation and interest may be formidable foes, but with the right mindset and strategies, you're the ultimate financial hero of your story. Stay financially savvy and see you next time.